When you're building a deal specification, what you're doing is that you're building some criteria that you want to go and acquire. Minimum criteria that you need is, of course, financial specification. Why is this so important? There's so many reasons why it's so important. But let's just talk about financial specification for a minute, yeah? So you've got financial specification. I'm going to call it spec. Now, I call it the target acquisition profile because you're targeting particular profiles of acquisitions. So your financial is, you're looking at minimum turnover, turnover and sales, and you're looking at minimum profit. They're ultimately the two things that you need to consider. And profit is more important than turnover, but you can't ignore turnover as well. The reason why profit is important is because that's what you can draw as an owner. Yeah? That's what you can draw into your pocket. Yeah? That's going to go into your pocket, your income, improve the life of your family, help you achieve the things that you want to achieve. So profit is the most important thing. But you can't ignore turnover. And the reason why you can't ignore turnover is because when investors and lenders are looking at the deal that you're trying to raise finance for, they are going to look at profit first, because ultimately that's the most important thing. But the second thing is that they're also going to look at turnover. And let's not, hide behind what the true reality is. The reality is that, let's say, what investors and lenders are looking at, they're looking at their downside. Okay, they're looking at their downside. They say, right, if for argument's sake, this person won't be able to pay me back the money that I've given them to go and buy a business for themselves, and the profitability goes down to zero, because you can have a profit of zero but have turnover, can I still recover my money from the turnover of the business? Right? Can I recover my money from the turnover of the business? Because ultimately what they're going to do, they're going to be like, okay, you're not making any money, meaning you're not going to make any money as the owner, but can you cut this expense back? For example, they say, right, you can't spend on marketing. What you used to spend on marketing is now going to be paid back to us. Now, is it a good position to be in? No, of course not. But that's what they're trying to protect. So that's why, although profit is your number one criteria, you can't ignore turnover. And also, if you watch the introduction to M&A strategy, that video there, then I say that the criteria of having a 2 million plus business when you're looking at acquisitions, or at least 1 million, that's when people start getting interested in even funding your deals in the first place, right? Now, in the value acquisition system, the better your deal specification is, meaning the higher quality, the more profitable. This isn't higher quality, it doesn't mean anything. The more profitable your business is, the higher turnover it has, the more attractive it is for investors. Because you want investors and lenders knocking on your door. Now, of course, no one's going to come to you and say, take my money like that, right? But what you're going to do is you're going to approach them, you're going to tell them what you're doing, you're going to tell them your thesis, you're going to go out and you're going to show them the deal. And when you show them the deal, and it meets this criteria of a minimum turnover, you're like, okay, I don't look at businesses which are less than anything than this turnover and that profit. Immediately the investor, the lender, they know, okay, this person is serious. They know exactly what they want, they've thought it out. They know that we only want to do deals in this size, this category. So therefore, this is a credible person that we can give our money to with a high chance of us getting a return on our investment. So that's why deal specification is so important. Right, the other thing that you need to consider in deal specification is, let's say you're a business owner right now. You're a business owner and you're doing, for example, 4 million in revenue. Yeah. You've got a profit of 400,000. I'm just going to keep it 10%. Okay. You've got a profit of 400,000. You need to now think to yourself, is it worth it for me to go out and do an acquisition? Now, by the way, it's never worth it to do a $250,000 meaning a 250,000 revenue business acquisition. It's never worth it. Even if that's your first acquisition and you've never had a business before, right? There's no point you doing a acquisition of even 500,000. Well, actually there is. What I'm saying is that if you've got a business which is doing 4 million in revenue, ideally you want to do an acquisition which is going to at least increase your business by 50%. If there are other businesses available in the market. Now, this is going into total addressable market, and let's touch on this a little bit. So total addressable market is your TAM. So what you have to look at is you have to look at your universe of acquisitions. Okay? Now, let's say for example, and remember you want to try and go for the top 30%, if not the top 50% of businesses in your industry. There's no point going for the bottom 50%. The bottom 50% are all crap. They're all crap businesses. The bottom 50% of every single industry are crap businesses. Okay? Well, that's not every single industry, but 95% of industries. So you want to look at businesses which are on the top 50%, ideally top 30% of your total addressable market. Now, for example, let's say you're sitting at the top 15% of your market. That means there's a significant amount of businesses which could be available for sale that you can go and acquire to double your revenue. So always try to do an acquisition where you can double your revenue. If you can increase your revenue by 4 million and take your revenue to 8 million with one acquisition, and take your profit from 400,000 to 800,000 with one acquisition, that's the ideal situation. Okay? That's the ideal situation. Sometimes it's not available. You can't do that. Yeah. So let's say, for example, you're a medium-sized business. Now, medium-sized businesses, remember, mid-sized businesses, mid-cap businesses I'm talking about. Let's say, for example, a mid-cap business, you've got a business doing 50 million in revenue. Okay. There's a bit of a problem here when you've got a business doing 50 million revenue. You would be considered a platform. Okay, a platform business. How many other platform businesses are out there in the marketplace that are even available to acquire? Your total addressable market, is it even available? It's probably not. And to be perfectly honest, the people who are interested in acquiring other $50 million revenue businesses are private equity firms and large strategics. So, for example, you've got a business. Let's say you've got 5 players in your industry that have got 500 million in revenue. They can go and buy a business quite easily and pay a premium for another platform business, because for them, a 50 million revenue business is a bolt-on. Yeah, it's a bolt-on. But for you, maybe your total addressable market and your buying power doesn't allow you to go and buy another business doing 50 million revenue, so you can't double your business. So you will focus on bolt-ons. Okay, so you will focus on bolt-ons. So what is a bolt-on acquisition? A bolt-on acquisition is buying a business which is smaller than your business, but it adds value to your business. So if you've got a business, you're doing 50 million revenue, and you buy a $5 million, I'm saying dollar, right? Let's just use dollars. You go and do a $5 million revenue acquisition, right? That's a bolt-on for you, and you've added 10% revenue growth. You know, when you're doing 50 million revenue and you're growing your business by 10% through organic means, marketing, sales, recruitment, you know, and the normal things that any business owner would do, that's great. But then you just added another 10% growth through a bolt-on acquisition. So that means that your business has grown by 20% in 1 year. And in 1 year, you've gone from a $50 million business to a $60 million business in 1 year. Okay, that's the power of bolt-ons. So when you're a medium-sized business, then you might need to focus on bolt-ons, because there might not be other businesses which are available, which is the same size as yours, similar size to yours. Now, if there is, then you need to do that. You need to go and get the acquisition. How can you do that? You have to go and get financial backing. So you've got private equity firms, you've got to find high net worth individuals, you have to find people who can give you money to go and buy the other platform. Because how good would it be if you've got a $50 million business and you bought another $50 million business, and now you've got a $100 million business through one acquisition? That would be fantastic, right? And I do hope it for you. If you're a medium-sized business, you're watching this video, try to find another business which is your size, but you have to get financial backing, because there's going to be big players, private equity firms are going to be really interested in those kinds of deals. And private equity firms, their whole business is to raise funds to go and do platform acquisitions, especially initially, and then they go and do bolt-ons afterwards. Okay? So always try to do a business acquisition which is going to try to double your size, if not 50%. So right now we're looking at business, for example, that is going to increase our business by 70%. Now we're quite excited if we can get that acquisition over the line. So always try to, try to do the biggest deal that you can. Always try to do the biggest deal that you can.